Hey everyone, Anthony Venuta here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and on this episode, we're going to talk about variable rate mortgages and people thinking about going into a fixed rate, what you need to consider. Stay tuned, you don't want to miss this. So as we approach the last few days right before the holiday season, I want to start off by wishing everyone a happy holidays, Merry Christmas, season's greetings, and we're hoping that everyone can get some time with their family over the next couple of days. And with that being said, I know a lot of clients, a lot of people that are on variable rate mortgages, a lot of first-time home buyers, people that are looking to get into the market or figure out their affordability when it comes to their mortgage and their debts is a lot of things that are keeping up clients tonight. We've been talking to multiple clients over the past several months, and especially approaching the holiday season where things are going to get a little bit more stressful for clients and what to expect in the new year. And with all that, there's a lot of things to unpack when it comes to looking at variable rate mortgage holders who are thinking about going into a fixed rate component, as we are starting to see signs that the fixed rate mortgages are dropping. And at this particular point in the game, fixed rate mortgages are significantly cheaper than variable rate mortgages, which could lead a lot of Canadians who are finding it stressful on a variable and making those payments to maybe securitize something that's a little bit cheaper per month. And obviously, it is a case-by-case example. Some clients that we're speaking to, they are in particular situations where they have very little choice. They do need to lock into a fixed-rate mortgage. And we do have some clients that financially are able to weather a significant storm on the variable side. But even if they're able to weather it or they are having to lock into a fixed-rate component, understanding the pros and cons and what to anticipate is very important. I know a lot of lenders are reaching out to clients, and I know Scotiabank has been in the news recently by telling clients to lock in, and they're issuing cashback components on that. And although that might be very enticing for some clients, we have to take into consideration what this could mean and where that could push Canadians, especially when you think about what the penalties are to get out of these fixed rate mortgages and if interest rates do fall on the fixed side. So obviously the cost of breaking these mortgages are expensive at the least. And if interest rates drop, obviously that differential is even higher. And speaking to a mortgage professional to better understand what those penalties could look like is important. But when we look at variable rate mortgage holders and what they should be looking at moving forward, especially if they want to lock in, is what happened over the last couple of weeks. So obviously we heard in December, the Bank of Canada increased its policy rate by an additional 50 basis points, bringing the policy rate to 4.25%, which therefore translates to prime lending, which is how the banks calculate their variable rates, prime moving to 6.45%, and then individually what your mortgage offset or discount would have been would determine the actual rate. So for example, if you have now prime at 6.45, and let's say you got 45 basis points off your existing rate, you would be at 6%. And something we talked about in last week's videos where interest rates have come back down, especially for insured and insurable mortgages, some clients might see rates that are below 5%. So you can see that that is definitely a significant savings in regards to your payment. And you can download our app in the description box below and start playing around. There are some rate options in there, and you can start looking at refinance calculators, lending tools, and obviously for first-time home buyers, closing cost calculators and so on. And for a lot of clients, we're talking to them about this transition and just making sure that they're aware of all their options. It's not necessarily saying, hey, you should be locking in, or hey, you should be staying variable. We present the option, say, hey, this is a good rate, this is how much you're gonna save, but keeping in mind, depending on that lender, these are the penalties that you can anticipate, and what are the options between a 1 to 3 year product versus a 4 and 5 year product. And as I mentioned, looking at Scotiabank and what they're doing, obviously it might be enticing to some clients because of that cashback component. If interest rates come back down, what is the penalty to that client? What is the benefit to that client? And how does that cashback component work if they break that mortgage? So it just begs the question of, is there an ulterior motive with the lender looking to securitize and lock in clients? Because as we're starting to notice, fixed rate mortgages are coming down. So something we talked about is OSFI leaving the stress test rule on December 15th. The Office of the Superintendent of Financial Institutions left the MQR, the mortgage qualifying rate, at 5.25. Arguably, a lot of people wanted that to change, but I think that by leaving it at 5.25%, it does bolster some of the housing market and obviously protects a lot of the lenders. But in January, we are going to hear from OSFI again when they're going to be basically revisiting some of the B20 guidelines, The B20 guidelines were initiated part of the stress test rules back in 2017, and they're going to review all the lenders and financial institutions, anything that's under their purview. They're going to go under, look at some of their policies and procedures, because over the last little while, what we have seen is banks definitely do a few things. We've heard from the banks that they're allowing clients to extend their amortizations, allow them to increase their principal if they can show distress and not be able to afford the increases. They're allowing them to tack on that difference to the principal. And extending that amortization is a big concern for lenders and for many people, even for you as a variable rate mortgage holder or a fixed rate mortgage holder, because it can hand tie you to the lender down the road. If there's no provisions made, you might be stuck with that lender. And obviously this is something that we need to pay attention to before you think about locking into a fixed rate mortgage, is how this will play out for you in the long run. Because decisions you make today can impact you down the road significantly, and that's something that we saw. And I want to just draw us back to 2020 when the whole pandemic hit. Banks were reaching out to clients to lock in, and then obviously different time, different circumstances, but it just paints a picture that at that time clients were locking in, and then we saw the market basically turn around and interest rates drop significantly and home prices skyrocket, and a lot of people that locked in we're trying to get out and obviously paying penalties. So as I said, just weighing out those options, act in patience, take a deep breath. I know for some Canadians it can be very hard. It's easier said than done. I get it, but we're just looking at those components now. Obviously, OSFI, Bank of Canada, which is very important to look at where variable rate mortgages could be headed. And one thing that we hear from the Bank of Canada, something we've talked about on this channel, is literally the fact that we are going to be data dependent. A few things. Obviously, for those Canadians who purchased homes at the height of the market and have variable rate mortgages, it can be painful. But obviously, we understand that these Canadians are facing these challenges. And the Bank of Canada has basically taken a step back from their aggressive policy stance and increasing policy rate to data dependency. That's not to say that the Bank of Canada will not increase policy rates in 2023, but they're going to be looking at numbers like the CPI, the data from Consumer Pricing Index, employment, economic growth, and of course, internal and external factors, domestic and foreign. And with the data coming on a Wednesday, that inflation has come down a little bit. And even though core inflation, so there's headline inflation, which is Canada at 6.8, but there's core inflation, which is your matrices like food, fuel, and energy. All those things are definitely still sticky and still remain relatively high, which leads many to believe that we could potentially see a further increase in January. Right? This is why we're having that conversation with variable and fixed rate mortgages, where clients see things headed. Because ultimately they make the ultimate decision on whether or not to lock in or not. And if you're deciding on whether to do that, you should be looking at where the Bank of Canada is headed and looking at what they're looking at in order to help you make a better and informed decision. But keep in mind, this component is what we're talking to our clients about, is that Bank of Canada will be meeting again on January 25th. And that will be the next time the Bank of Canada meets to make a policy rate decision. But more importantly, on January 17th, we're going to be awaiting the next set of data from CPI. So just recently we heard for November, and in January we're going to get December's data. And keeping in mind, obviously it's the holiday season, economists are going to perceive and digest this information differently. There's going to be potentially multiple sides. It depends on what side of the fence you're on. But this could lead to the bond market. Basically, what we're looking at is the 5-year Treasury. So 5-year Treasury is generally the leading indicator for 5-year fixed mortgages, and how banks and lenders will basically look at that, what premiums they're going to add to it. Now, taking a step back, looking at the bond market as a whole, a lot of conversation around inversion and recessions. Obviously, we know that there could be potential for a recession if we're not already entering one, because of the inversion in the short-term to long-term bonds. Now, I'm not going to get into that much detail regarding the bond market, but it's important to pay attention to. When short-term bonds are more expensive than long-term bonds, it leads many to believe that a recession is imminent. But what it does lead to is that as we start to see the 5-year Treasury bond sort of come back down, and we looked at it from May, which was around 4%, and now we're hovering just in the low 3%, that rate is starting to come back down as we're starting to get some indications from the markets. Whether it goes up or down in the next few months, it's important to keep an eye on it. That's what we're trying to say, is especially if you're locking into a fixed rate mortgage. So yes, obviously bond markets are starting to show themselves down. Now, and one important thing with that, and something that we're talking with, not only with our lenders, but because the banks finished their year end and now they're starting to approach the new year and looking to increase their profits, are they going to be more competitive come the spring? And are they going to be more competitive? Because a lot of banks haven't necessarily translated the discounts in the bond market to their fixed rate mortgages. Some have, a lot of monoline non-lender banks have done that, but a lot of the conventional banks may have not done that right away. They're waiting to see what happens before they translate those discounts, as there might be an opportunity for them, like Scotiabank, to keep those potential rates a little bit higher, lock in a lot of clients, increase those profits. Not saying that that's the case, but we have to take a look at it from both sides of the fence. So obviously, if you have a variable rate mortgage and you're thinking about locking in the new year, make yourself a checklist of things to consider. Obviously, understanding your financial situation, providing yourself with a budget, looking at your employment, and so many other things. And with that, I want to wish everyone a happy holiday, Merry Christmas again, season's greetings, and we'll remind everyone that if you like the content that we're producing here at In Touch Mortgage Solutions, we would like and appreciate if you would hit the like, share, and subscribe button, hit that notification bell, and share the video if you know someone that could benefit from this conversation. But with that being said, we wish everyone a great Friday and even better weekend ahead. Thanks for watching, and we'll see you next week.